Hi guys, this is the Smart Invest. Today, we're going to delve into a topic that every investor and trader wants to hear about: the dangers of leverage and borrowed money in investments. I need to emphasize that this video does not provide financial advice. What is this mysterious force? Why should we be cautious, and what does everyone need to know? That's what we're going to talk about today. What is leverage? First of all, let me explain what leverage is. Leverage is a technique where an investor or trader uses borrowed money to increase the size of their positions. Leverage is when you want to make money with money that isn't actually yours. For example, if you have $1,000, leverage allows you to take larger positions, let's say $10,000 positions, or sometimes even $500,000 positions. It's important to note that massive gains and losses always go hand in hand with leverage. When things are going well, you might quickly multiply your capital. But if the market turns against you, you can suffer significant losses just as quickly, or in extreme cases, even lose more than your entire capital. It's crucial to have the right knowledge and always use stop-loss orders. There have been cases where enthusiastic beginners ended up in deep financial trouble due to a misguided financial move, and they had to pay off their debts afterward. Fortunately, brokers these days don't often allow beginners to go into negative balance, but it's always important to use stop-loss orders. Margin call: a financial horror story. A margin call is a situation where the broker asks you to deposit more money into your account because losses have exceeded the allowed limits. In such cases, your margin slowly depletes due to losses, and you need to make additional deposits to cover your trades that are already heading in the wrong direction. It's like when you see a pile of your money on fire, and you throw more money onto it, hoping to extinguish the fire. If you can't meet the margin call, the broker can automatically close your positions, causing massive losses. Psychological pressure. It's important to mention that using leverage can impose significant psychological pressure. People tend to take on too much risk, and their decisions can be influenced by emotions when trading with capital larger than their own. If you know you have $1,000 in your account, and your monthly free cash flow has been $700 for years, and you're smart enough to assess your own situation, then you might not be able to handle a $100,000 position with the same composure as a $100 one. Just imagine how you'd react if you lost $10 from your pocket on the street. You'd probably be a little upset, but you'd likely move on. Now, imagine you have an envelope with $10,000 in your pocket. You received it as a reward from your boss for outstanding work last month. In some parallel universe, you've already mentally spent that money on incredibly useful things. How would you feel if you hurriedly lost the $10,000? How would you compare these two feelings? Before we continue, if you found this video useful, don't forget to share and like it, and subscribe to the channel for more useful content. Preserving long-term capital. Preserving long-term capital is crucial in investments. Using leverage can be contrary to long-term goals because it's based on short-term market fluctuations. Warren Buffett's #1 rule is never lose money. It's relatively challenging to build wealth in the long term. If you occasionally lose half of your capital due to leverage and a plan that you thought was well thought out but, in reality, was doomed from the start. Of course, everyone loses money from time to time, even Warren Buffett. But with every investment, our primary goal should be not to lose money. I've brought you 3 examples. Big names in the investment world who thought they were smart enough to use leverage to their advantage but ended up losing everything. John Meriwether. He was the founder of Long-Term Capital Management, LTCM, a hedge fund that used high levels of leverage and complex financial strategies. In 1998, LTCM faced a severe financial crisis, and the U.S. Federal Reserve had to orchestrate a bailout to prevent a larger financial meltdown. Nick Leeson. While not a traditional investor, Nick Leeson was a derivatives trader for Barings Bank in the 1990s. He engaged in unauthorized and risky trades that ultimately resulted in the bank's collapse. Brian Hunter. He was a trader for Amaranth Advisors, a hedge fund specializing in energy trading. In 2006, Hunter's bets on natural gas futures went wrong, causing Amaranth to lose billions of dollars and eventually shut down. The lesson: in conclusion, always learn and prepare before you start leverage trading or investing. Understand the markets, comprehend the risks, and don't take on more risk than you can afford. Always remember that even very smart people have burned themselves with this. This concludes today's video. Remember, leverage offers opportunities and risks. It can take you to the sky, but it can also give you a hard lesson. Always be cautious and keep long-term goals in mind. Don't put your safety savings into Shiba Inu tokens just because your hairdresser did. If you found this video useful, don't forget to share and like it, and subscribe to the channel for more useful content. Thank you for watching the video, and see you in the next one.